Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 3 dividend-paying companies that have seen a major pullback in share price as of late and are now trading very close to their 52-week lows. The overall market has seen a significant pullback during the past few months, and the S&P 500 is now down over 8% from its high. So a lot of big name companies that pay out very strong dividends have seen a major pullback as of late as well. And in this episode, we're going to go over 3 companies of the many that have hit 52-week lows during the past few weeks. We're going to take a look at their current financial information, their future expected growth, and the dividend information for all 3 of these companies. But before we jump into that first dividend paying stock, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and on this channel we talk about the stock market, go over any major market news, and we also track the progress of my personal dividend growth portfolio. So of course, when you're purchasing strong companies, you want to buy in when share prices decline, you want to buy the dip and get a nice high starting yield. And for all 3 of the companies we're going to go over in this episode, you're going to get just that. So now we're going to jump right in to dividend paying stock number 1 that is trading very close to their 52-week low and has gotten absolutely crushed as of late. And that is ticker HSY for the Hershey Company, the major chocolate and snack food brand. They currently trade for $194. On the 12-month chart, they are only down 13%, but if we zoom in from their peak earlier this year, the company is now down over 29% from their most recent high, a significant pullback from over $260 per share, right around this $194 level. The company is now trading with a forward P ratio of 20.5. If you were to buy into the company today, you would also get a starting dividend yield at 2.44%, and Hershey's market cap is slightly above $40 billion. So if we jump over and take a look at this company's wide variety of snack food products, we can see, of course, the brand name Hershey's chocolate, the Reese's, the Kit Kat, the caramels, the Rolos, and many more. This company is one of the strongest snack food portfolios in the entire food market. And of course, with this strong portfolio, they have generated growing revenue year after year over the past 5 years, from $7.7 billion back in 2018 that has climbed consistently to over $10.8 billion of total sales in the trailing 12 months. And if we jump over to the cash flow statement, net income each and every year has continued to climb to around $1.8 billion. Their cash flow generated from their operating activities continues to climb as well. And after their capital expenditures of only $600 million, this company continues to generate growing free cash flow each and every year. And if we jump over to their latest investor presentation, we can see they're outpacing their industry. Hershey's net sales growth on a 5-year CAGR is at 6.8%. Meanwhile, the S&P 500 food category is only at 3.7. So they're significantly outpacing net sales growth relative to other food-based companies. And of course, if we take a look at the net income or the earnings per share, Hershey's is growing at a CAGR of 12.3%, which is incredibly fast EPS growth, especially for a snack food company compared to their industry at only 2.7%. And overall, this business continues to grow at a record pace. Operating cash flow is growing at a CAGR of 13.3% over the past 5 years. This operating cash flow growth is very impressive for every type of business, especially when you operate in a slower market such as snack foods. Showing this high double-digit consistent growth over the past 5 years is very, very impressive. And of course, as a dividend investor, we love to see this dividend CAGR at 8.7% per year on average during the past 5 years as well. And if we take a look at Hershey's relative to the margins in the industry, they are again outperforming their competitors. Adjusted gross margin in 2022, Hershey's came in at 44%, the leader in the food category. Adjusted operating margins of 23% are 5% higher than their next competitor. So overall, this company continues to generate growing revenues, and because they have higher gross and operating margins, that directly translates to higher profits relative to their industry peers. And with Hershey's, although they've performed very strong historically over the past 5 years, they're still forecasting long-term growth in the business, and they have no signs of going flat anytime soon. They're forecasting net sales growth anywhere of 2 to 4% through 2026 and onward, and adjusted EPS growth from 6 to 8% during that long-term period as well. And if you read the transcript of their most recent earnings call, these are very conservative estimates. These estimates do not include any accretive acquisitions that the company may make over the next 3 to 4 years as well, which will only boost this top and bottom line numbers. And of course, when you're buying the dip on a company like Hershey's, you're looking for that nice dividend income. So like we saw, they have a starting yield at 2.44%, a very safe and conservative payout ratio at only 45% of their net income. Their 5-year dividend CAGR is at 9.8%, and they have a 13-year dividend growth streak. And if we take a look at their Simply Safe dividend score, it does come in at a 93, meaning the dividend is considered very safe and very unlikely to be cut anytime soon. So Hershey's, the snack food company, is the first strong dividend-paying companies that has seen growing operations historically that has seen an over 29% decline in share price from their most recent high, and is definitely worth taking a look at, and is definitely a dividend-paying company to buy during this massive dip. So now we're going to move on into the second company for this episode, and we have another consumer brand name. We have ticker KO for Coca-Cola. The company now trades for $54 per share. This is the leading beverage company on the planet. They have over 200 different beverage brands being sold all around the world. The company has a market cap at $228 billion, a nice high starting yield at 3.5%, and is trading with a forward PE ratio right around 20 after this most recent decline. But earlier this year, Coca-Cola stock had reached a peak at over $64 per share, and from that high point, it is now down close to 16%. So as the company's share price has contracted, their actual underlying business operations have expanded, and the company has reached higher revenue in the trailing 12 months compared to prior periods. So we can see in the trailing 12 months, they generated $44 billion of top line revenue, which has seen continuous increase each and every year over the past 5 years, which is a very strong sign. And of course, when you think of Coca-Cola, you think of a very strong historical established American brand. But if we take a look at the net revenue breakdown, only 35% of the revenue comes from within North America, 65% or majority of the net sales comes from a global scale, which only strengthens this business's operations. They're not focused on one geographical region for a majority of their revenue, it's diversified across the entire world, which is great to see. And overall, this business has 26 individual billion-dollar brands within their portfolio. So when you think of Coca-Cola again, you think of the flagship Coca-Cola products, Coke Zero, Sprite, and a lot of the big names. And of course, those products do generate a ton of sales for this business, but of the $44 billion of total revenue, 26 individual brands each generate over $1 billion in annual sales, so they have a nicely diversified product mix. If one individual product line may decline in revenue, they have 25 other billion-dollar brands to help pick up the total sales, and again, strengthens the portfolio of this conglomerate and the leader in the beverage industry. Overall, their organic revenue growth over the past 5 years has been a CAGR of 7%. Their EPS growth is growing at 6% on average over the past 5 years as well. And what I find extremely impressive and the strongest growth metric over the past 5 years has been the company's ability to expand their free cash flow from $5.3 billion in 2017 to over $9.5 billion in 2022, a CAGR of 14%. Free cash flow is very important as it allows the company to pay down debt, pay out that dividend, and of course buy back more stock. So for dividend investors who are looking for a very strong total return, growing free cash flow is a great sign of the company's strength in their operations. And if we can see, for a company like Coca-Cola, this is a very large-scale beverage industry, and many people don't see any growth in this market. But we can see back in 2017, the total addressable market was only $650 billion. That expanded to $1.3 trillion in 2022. And over all their different product categories, they're expecting a minimum of 4 to 10% CAGR per year from 2023 through 2026. So of course, Coca-Cola owns a large share of each of these individual industries. So right away, we're expecting revenue and profit growth anywhere from 4 to 10% over the long term as well. And if we take a look at their forecast for the future, for long-term targets, these are 5, 10-year expected growth rates. They're forecasting organic revenue to be 4 to 6%, operating income to be 6 to 8%, EPS between 7 and 9, and their free cash flow conversion to be anywhere from 90 to 95%. And now if we take a look at that dividend, they have a yield at 3.5%, which is a very strong starting yield. They pay out $1.84 per share per year. Their net income payout ratio is right around 70%, with a 5-year dividend CAGR at 3.4%. And of course, this is a very strong, well-established dividend king with a 60-year streak of consecutive dividend growth. And if we jump over to Simply Safe Dividends, that represents a dividend safety score of 80. So again, another very strong business that is unlikely to cut that dividend payment to their investors anytime soon. So Coca-Cola was stock number 2 for this episode, and now we're going to move into the third and final company we're going to discuss. We're leaving the food and beverage sector behind. We're moving on to an industrial and service company, and that is ticker UPS for the United Parcel Service. The company currently trades for $155 per share. They're one of the leading logistics companies on the planet. They have a 4P ratio of 16.5, a very nice and high dividend yield at 4.2%, and a current market cap above $131 billion. And of course, similar to Hershey's and Coca-Cola, from a high point earlier this year, and UPS peaked at around $195 per share, they're now down over 20%, back down to this $155 level. And if we take a look, this company operates in over 220 countries and territories. They operate over 580 aircrafts, over 125,000 delivery vehicles, and delivered over 6.2 billion letters and packages in 2022 through 750 plus individual airports. So they operate on a global scale. They have massive, well-established operations. And with a company like UPS, this is a very hard industry to get into. They already have the logistics set up. They already have the operation set up, and that gives them a wide moat in this delivery network. And we can see in 2022, for their entire year, they saw very strong results. Revenue grew, margins expanded, they had higher return on invested capital, all great signs for the business as a whole. And if we take a look at a 5-year perspective, total revenue has continued to grow over the long term from $71 billion back in 2018, consistent growth to over $100 billion of sales in 2022. They have seen a slight pullback as of late. Higher inflationary costs have reduced some shipments during the current year, but over the long term, this business has very strong growth rates. They're expecting double-digit expansion in revenue going forward, and I'm not really worried about the slowdown in the current year's sales. And of course, the company also did have some negotiations with their employees. That has all been settled. The contracts have been signed. So going forward, they're planning to operate smoothly with no significant further issues. And of course, when you buy into the shares right now, you're getting a nice high starting dividend yield at 4.2% for a company that's continually grown that dividend for 14 consecutive years. And they also buy back shares as well, with a new $5 billion share repurchase authorization being introduced in late 2022. So of course, as long as you are continuously getting that growing dividend, you're also getting a higher ownership share of the company as they buy back their stock every single year. And if we take a look at the dividend, like we saw that 4.2% starting yield, the annual payout of $6.48 per share, they still maintain a very conservative net income payout ratio at only 55%, with a 5-year dividend CAGR of 12.38% and a dividend safety score coming in at 69, so the dividend is considered safe. So UPS, one of the world's leading logistics and delivery companies, comes in at stock number 3 for trading very close to their 52-week low. So overall, the market has seen a significant pullback as of late. In this episode, we discussed the Hershey's Company, Coca-Cola, and the United Parcel Service, 3 very strong dividend-paying brands that have long double-digit dividend growth streaks, have seen growing operations over the past few years, but have seen a significant pullback as of late, and are definitely worth doing some research into for your own portfolios. So I want to thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.